All right, guys, so today we're talking about how to buy an investment property in California without having to show any income to qualify. So I just helped a couple clients use a program like this and thought it'd be helpful to go ahead and share. So this program is known as a DSCR loan, which stands for debt service coverage ratio, which is just a fancy way to say that the market rent for the property need to cover the mortgage payment that you're going to have on the property, which is a debt that you have. And so the main piece to qualify for a loan like this is that those market rent cover the mortgage payment, and as long as they do, you'll generally qualify for the loan. So in this video, we're going to go ahead and cover things like credit, income, and assets, and what's required to go ahead and be able to use a program like this. But before we go into all that, who is this program good for? This program is generally going to be good for someone that just doesn't want to show any income to be able to qualify for the next investment property. And the reason for that can be various reasons, right? It can be either maybe your income situation is complex with your job, or your income varies, or something to that effect. You can be self-employed and maybe don't show enough profit on your most recent tax returns for whatever reason that might be. Or maybe you are self-employed, or you have multiple businesses and you just have a complex income scenario and you don't want to have to go through the rigorous underwriting that requires submitting tax returns, explaining why this income is that way, and maybe you have properties and things along those lines. There's multiple reasons why someone would want to go ahead and use a program without having to show income to go ahead and qualify. So that's who this program is going to be good for. Someone that doesn't want to show income. If you are able to show income and you have your down payment for an investment property, then you might as well use conventional financing because it's going to be much cheaper. Rates are generally going to be lower on something like that. But if you don't, then this is a great alternative to be able to still be able to get in the door and buy an investment property, whether it's your first investment property or you've got multiple already. So the first piece of this is credit. So the minimum credit score requirements on this are generally going to vary depending on which bank or which lender you're using. And there are several banks and lenders that offer these type of programs. But in general, what I've seen from the different banks and lenders that I've worked with is that the minimum credit score is 660 or above, generally somewhere in the 600s range. And there's different factors that go into that. But in general, a 660 or above credit score is what I've seen out there. Now, do you want to buy an investment property using this type of program with a 660 credit score or above? You might not want to. Although they allow as low as 660 or above, generally your rates are going to be much higher and requirements are going to be much higher if your credit scores are 660 or above. When it comes to credit, because this program doesn't account for any income or debt to income ratios like a standard conventional loan might require, it just, again, it goes back to just, can the market rents for this property, meaning can the rents that are being paid to you by the tenant cover the mortgage payment? If they can, you qualify. So because there is not a whole lot that goes into the income, the debt payments that are showing on your credit report, such as credit cards, installment loans, things along those lines, don't really matter a whole lot. It's more so of the score. But the one thing to note on this that I've seen is that most lenders and banks are require that you have made the last 12 months of your housing expense on time at least. So if you rent, they're going to want to verify that you've made the last 12 months of rent payments to your landlord or whoever you're renting from, and want documentation for that. If you have a mortgage payment, then that mortgage payment is likely going to show on your credit report, and they'll want to verify that you've made the last 12 months of mortgage payments on time. And the reason for that is just simply risk, right? And making sure that if they do give you a loan like this, that you are responsible enough to go ahead and make the mortgage payment on this if your tenant maybe decides not to pay you, or if it takes some time for you to find a tenant, or something to that effect. Rates on this program are generally going to be in that 8 to 10% range, which is going to be generally higher than using a standard conventional loan. The reason for that is it's considered higher risk. So again, if you buy with a 660 credit score, chances are your rate is going to be on the higher side of that. If you buy with a 700 plus credit score, then it'll probably be on the lower side of that. But in general, I've seen 8 to 10% interest rates when using this program. Now, the next piece of this is income. The beauty about this program and the main benefit is that, again, you don't have to show income to be able to qualify for this. So no tax returns that you have to submit, no pay stubs that you have to submit, no W-2s, nothing along those lines. The only reason where you would, or the only scenario where you would have to submit some type of income documentation is, let's say you own a business and they need to document that you are 100% owner of this business or something to that effect. And you might need to show Schedule C from your tax return if you're a sole proprietor, or a K-1 if you have some kind of corporation showing your ownership percentage, but they don't want to see any of the income related stuff because it doesn't matter in order to be able to qualify for this particular program. And then lastly, the assets part of this. So this is probably the second most important part of using a program like this. They're big on, any lender or bank that I've worked with when using a DSCR loan, they're big on the assets and how much is available. So because it's considered higher risk, they offset that higher risk by verifying that you have some liquid assets in an account that you can show that you at least have in case, again, you can't find a tenant for the property, or maybe you have some vacancy and they want to make sure that you're going to have some reserves, quote unquote, and a large enough down payment to where you have enough skin in the game that you will be responsible enough to go ahead and make the mortgage payment. So in general, the minimum down payment required is going to be 20% or above to be able to qualify for a program like this. So if you buy a $500,000 home, that's $100,000 in down payment. And then the second piece to this is that they'll generally require that you have a few months of the mortgage payment in reserves to be able to show for and offset some of that risk. So the lowest that I've seen in terms of reserve requirements is going to be 3 months. So if you, let's say, buy a $500,000 home with a $100,000 down payment, let's say the payment on that is $3,800 or so, they're going to want to see that you have $3,800 times 3 or above. Again, the lowest I've seen is 3 months in an account, and that could be a checking, savings account, retirement account, brokerage account, things along those lines, to be able to show the underwriter. And you don't necessarily have to liquidate it, but you have to show them that you have it available. So now, what are the situations where this asset requirement could increase or change? Let's say you buy a $500,000 home and you're putting 20% down, which is $100,000. Let's say your mortgage payment on that's going to be somewhere in the $3,800 range. And once you get your offer accepted and get in a contract, what the bank is going to do is they're going to send an appraiser out to the property to, one, confirm that this property is worth what you're paying, but two, confirm what the market rents are on this property, which really just means what is the public willing to pay in rent for a property like this if they were to go ahead and rent this out. And so if that appraiser says that the market rents are $3,800 or above, then you're clear. You're good to go. You're 20% down. You've got your 3 months reserves. You can qualify for this mortgage, right? But oftentimes, or sometimes, the property doesn't cash flow right away, especially if you're living in California with prices where they're at and rates where they're at. It's not always going to be able to go ahead and cash flow. So let's say it doesn't cash flow. Let's say the rents come in lower. Let's say $3,500. You have a couple different options. Option one is going to be to find a way to lower your monthly mortgage payment. So if your mortgage payment is $3,800 and the market rents say that they are $3,500, find a way to lower your monthly mortgage payment enough to be able to meet that $3,500 market rent that the appraiser is showing. And you can do that a few different ways. One is to increase your down payment. When you increase your down payment, it lowers your loan amount, which lowers your mortgage payment, which could potentially match to that $3,500 mortgage payment. Second way is to lower your interest rate, to buy down your interest rate by paying discount points. Now, whether this is a smarter idea or not, depending on what your plan is with the property, whether you're deciding to keep it short term or refinance in the next few years, is a conversation to go ahead and have with your lender to figure out whether the math checks out on that. But the second way to do that is to be able to buy down your rate by paying discount points. Or the third option, provided you have a willing sellers, to renegotiate the purchase price. If you renegotiate the purchase price to a lower purchase price, it lowers your down payment, it lowers your loan amount, which lowers your monthly mortgage payment, which means that your monthly mortgage payment might be able to meet that $3,500 market rents that the appraiser brought in. So that's option one. Option two is to go with an option that allows for lower market rents than what your mortgage payment is. So the DSCR ratio, if the rents were to have come in at $3,800 a month, what that means for the underwriter is that the DSCR ratio is 1, basically 1 to 1, meaning that $3,800 of market rents, if you divide that by the $3,800 in mortgage payment, then that equals to 1, and we're good to go there. It's 100% of the mortgage payment. Now, in the event that the appraiser says that the rents are lower, many banks or lenders will allow you to proceed with an option where they allow the market rents to be 75% of the mortgage payment. So if your mortgage payment is $3,800, 75% of that is $2,850. And so that would mean that even if the market rents are lower, you can still qualify for this. Now, the other side to this is that because the market rents didn't meet the mortgage payment, this is again considered higher risk for underwriter and the bank, and so there's usually going to be some kind of additional requirements, and it usually revolves around the asset requirements. So what that means is that instead of requiring 3 months of reserves like they normally would, they'll say, hey, we'll allow you to still qualify for this program even though the market rents don't meet the mortgage payment. But instead of 3 months of reserves, we either want 6 months or 9 months or 12 months of reserves. I've seen it be 6 months and I've seen it be 12 months, but generally they'll go ahead and increase that to higher reserves to offset some of the risk that they're taking. And then the second piece to this is that you'll generally have a higher interest rate when the market rents don't meet the mortgage payment. it's considered higher risk. So the lender will give you a higher interest rate. And so the other thing to consider is that if it's a higher interest rate, the mortgage payment then goes up, which means that the market rents also need to be higher, right? So there's some moving pieces there, and there's just it's a matter of running the numbers with your loan officer or lender to be able to make it make sense and make sure that it's still going to be a good fit for this particular property. And so that's how you buy an investment property in California without having to show any income. You use what's called a DSCR loan, debt service coverage ratio, and all that means is that the market rents for this property that a tenant might be willing to pay have to equal the mortgage payment. So keep it in mind out there if you are looking to buy an investment property and maybe don't qualify for conventional financing because of the income requirements or for one reason or another, this might be a second alternative, and you can keep this loan for as long as you want to go ahead and keep it, or decide to refinance if you think the rates are high and you're going to be able to show enough income in the next couple of years. You can refinance into a conventional loan when your income is in a position to be able to qualify, or maybe when rates drop. So hopefully this is helpful. Add a comment below with any questions you might have, and we'll see you guys on the next one.